Okay, Assalamualaikum and a very good morning to Arif and fellow friends. Today we would like to present to you about financial statement analysis. Before we start, let's recite a doa. Okay, first we look into financial analysis. What is financial analysis? Financial analysis is an assessment of a firm's past, present, and anticipated future financial performance. We have to identify SWOT or do SWOT analysis to know the firm's performance. Next, we learn how many types of ratio comparisons. There are two types of ratio comparisons. The first one is internal, trend analysis, or we call it as time series. We compare the ratio year by year. The second one is external, inter-firm comparison, or cross-sectional analysis. We compare the ratio with other firm or industry. There are 5 types of ratio. The first one is liquidity ratio. We look into the ability of a firm to cover its short-term obligation. The second one is efficiency ratio or asset management ratio. In this ratio, we want to know how effective a firm in managing asset in generating sales. The third one is leverage ratio or gearing ratio. It indicates the extent to which business is reliant on debt financing. This ratio also measures the level of debt. The fourth one is profitability ratio. We measure how effective a firm to use its asset to make profits. And the last one is market ratio. It relates to the firm's stock price to its earnings and book value per share. Here are some benefits of ratio. The first one is helpful in decision making, helpful in financial forecasting and planning, helpful in communication, helpful in coordination and control, helpful for shareholders' decision, and lastly, helpful for creditors' decision. Now we look into the limitation of ratio. The first one is difficulties in identifying suitable industry category to classify a firm. Firm may be involved in many different activities. The second one is effect on inflation ignored because it can distort figures. The third one is accounting practices may differ between firms, complicating comparison of result between firms. The fourth one is result may be distorted if there exist charges in the accounting standard resulting in changes in the presentation of financial result. And the last one, firms may experience seasonality in their performance. Okay, now we go through how to calculate liquidity ratio. First is current ratio, current asset divided by current liability. For year assessment 2012, current asset amounted to 1,405,995 divided by current liability amounted to 1,776,885. You get 0.79 times, which is lower compared to your assessment 2013, which is 1.60 times. It indicates better performance of astromeasurable height during the year assessment 2013. Okay, next we look at the quick ratio. The formula is current asset minus inventory minus prepaid expenses divided by current liability. For your assessment 2012, current asset amounted to 1,405,995 minus inventories amounted to 1,3291 minus prepaid expenses amounted to 126,894. We get this answer, and divided by current liability amounted to 1,776,885. 5. And you'll get 0.71 times, which is lower compared to your assessment 2013, which is higher. This is also indicate the better performance of Astro Malaysia Berhad during the year assessment 2013. Okay, in liquidity ratio, we will look at the current ratio and quick ratio. For both ratio, Astro Malaysia Berhad have higher ratio in your assessment 2013 compared to your assessment 2012. It means that 2013 ratio is better than 2012 ratio. Astro Malaysia Berhad are able to cover its short-term obligation. This might due to higher liquidity asset, increase in sales, and good in-depth collection.
Today, I will continue a second part is a fancy ratio. Firstly, you must calculate inventory turnover ratio. Let me share with you the formula is cost of goods sold divided closing stocks. Firstly, RM 221267 divided 13291 equal, we will get 166.48 times for year assessment 2012, and for year assessment 2013 we will get 110.47 times. The performance during the year is was seen 2013 is lower than year assessment 2012. And the secondly is average collection period, account receivable divided annual credit sales times 360 days. For year assessment 2012, we will get 63 days, and year assessment 2013 we will get 57 days. The performance during the year is better seen 2013 is lower than 2012. And thirdly is a fixed asset turnover, means sales divided net fixed asset. We will get 0.75 times for year assessment 2012, and for year assessment 2013 we will get 1.07 times. The performance during the year is better since 2013 is higher than 2012. And lastly is a total asset turnover. Sales divided total asset include current asset and non-current asset. We will get 0.59 times for year assessment 2012 and 0.65 times for year assessment 2013. The performance during the year is better since 2013 ratio higher than 2012. For in this ratio, we will look at average collection period, inventory turnover, fixed asset turnover, and total asset turnover. For average collection period, fixed asset turnover and total asset turnover, the company shows lower and higher ratio in year assessment 2013 respectively compared to last year. It means that this year ratio is better than the last year ratio. For inventory turnover, Astro Malaysia Berhad shows lower ratio in year assessment 2013 compared to the last year. It means that the company shows worse performance this year. The company might facing difficulties in replacing stock. This might due to poor in sales promotion, poor in stock control system, and poor in debt collection. And the third part is gearing or leverage ratio. Firstly, debt ratio, total debts or total liability divided total assets times 100%. We will get for year assessment 2012 92.46%, and for year assessment 2013 we will get 92.08%. The performance during the year is better since 2013 lower than 2012. And the secondly is a debt to equity ratio, means total debts divided total equity times 100%. We will get 1225.44% for year assessment 2012 and 11629.24% for year assessment 2013. The performance during the year is worse since 2013 is higher than 2012. And then lastly is a times interest earns, mean earning before interest and tax divided interest expenses times 100% means 5.54 times for year assessment 2012 and year assessment 2013 3.06 times. The performance during the year is worse since 2013 is lower than 2012. In this ratio, we will look at the debt ratio, debt to equity ratio, and time interest earned. For debt ratio, the company shows lower ratio in year assessment 2013 compared to year assessment 2012. It means that Astro Malaysia Berhad have better performance in that year. For debt to equity ratio and the time interest earns, Astro Malaysia Berhad shows higher and lower ratio respectively in year assessment 2013. It means that the company have worse performance during the year 2013. The company might difficulties in collecting debts. This might due to more rely on debt financings and fail to manage interest obligation.
Assalamualaikum to all the viewers. I will explain to you guys how to calculate profitability ratio. Profitability ratio is to see how effective is the company using their asset to gain profit. First of all, we will calculate gross profit margin. The formula is gross profit divided by sales and then times 100%. How we get the gross profit margin? The gross profit margin we can get from the statement of comprehensive income over here, and sales is also known as revenue over here. On the year 2012, the gross profit margin is higher than the year 2000 from the year 2013. The higher gross profit margin is the better because it indicates how efficient in controlling cost of goods sold and have a good pricing policy. The second one is operating profit margin. The formula is EBIT divided by sales and then times by 100%. EBIT is earning before interest tax. How we get the EBIT is from the profit before tax and then plus with the finance cost. Finance cost also known as interest. The higher the operating profit margin is the better because to see how efficient in controlling their operating costs. On the year 2012, the operating profit margin is higher than for the year 2013. The next one is ROCE is return on capital employed. The formula is EBIT divided capital employed and then times by 100%. How we get the capital employed? The total equity plus with the borrowing over here. Okay, and then after EBIT divided by capital employed times by 100%. The same goes to for the year 2013. The next one is net profit margin. The formula is net income attributed to common stock holder divided by sales and then times by 100%. How we get the NIATCS is we get from the equity holder of the company over here. Okay, net profit margin. The higher net profit margin is the better. The company, which means the company are able to generate high net income. On the year 2013, it's showing that the net profit margin reduced for the year. It's showing that the company unable to generate high net income. The next one is return on asset. The formula is NIATCS divided by the total asset then times. Okay, how we get the total asset? Non-current asset plus with the current asset at the bottom here plus this two. And then high return on asset is the better because the company are able to make profit from their investment in fixed asset. On the year 2013, the company's return on asset is declined. To compare then the 2012. Lastly, the return on equity. The formula is NIATCS divided by common equity and then times by 100%. How we get the common equity? The total equity is also known as the common equity. For the year 2012, the return on equity is higher than year 2013. The higher ROE is the better because the company are able to maximize their shareholder wealth. For the conclusion, the company have lower ratio in year 2013 to compare last year. It means that the company has worse performance for the year. The company might face difficulty in making profit. This might due to insufficient sales volume, higher production wages, and not efficient in utilizing its assets. That's all from me. Thank you for listening.
Good afternoon. Lastly, margin ratio. This ratio provides investor with the information as to the extent to which the management of the firm and be efficient in ensuring that the business earns sufficient return on its provider of finance, debt and equity. Firstly, earning per share. Earning per share, the formula is net income available to the common shareholder divided by number of ordinary share in issue. If you see this form, we use this formula, we get in year 2012, we get RM 0.5611 and year 2012 RM 0.5641. The highest will be year 2012 and dividend per share, the formula is ordinary dividend divided by number of ordinary share in issue. And year 2012 we get 0 only and year 2012 we get RM 4 ringgit 0.249. And market dividend payout ratio. The formula is dividend per share and divided by earning per share. Into year 2012 we get 0 times and year 2030 we get 8.599 times. Earning per share ratio is the formula is market per share divided by earning per share. In year 2012 we get 0 and year 2030 we get 8.095. And lastly, the market ratio formula, dividend yield. The formula is latest annual dividend divided by market per share. In year 2012 we get 0 and year 2013 we get 0.93. The market ratio is measured the instant to the firm which the firm is able to earn sufficient earning and return to the investor. The market ratio include earning per share, return on capital employed, return on asset, return on equity. In this ratio, we will look at the EPS, DPS, DPR, PER and ER. For all dividend per share, dividend pay ratio and price earning ratio and dividend held to the last year. The company have higher ratio in the year 2013 compared to the last year. It means that the company have better performance on this year, that is 2013. Meanwhile, EPS in 2013 show lower ratio compared to year 2012. It means the company have worse performance in this year. We end our session with Tasbih Kifara and Suratul As. And thank you.